Hello, my name is Adrian Boothie from Trend Signal. We're going to look at an OCO order. Now, an OCO isn't really talked about too much anymore. It's sort of old parlance, really. But basically what it means is that when we have one order in, or two orders in place, if one gets hit or filled, then it cancels the other one. So it's particularly useful. We're not so familiar with that terminology these days, though, but I very often, if you're placing a trade, you're in a trade, you've got a stop loss in and a target in, what you'll notice is that whichever one gets hit first, it will cancel the other, doesn't it? You ever notice that? So when you're in a trade, maybe it's going to hit your stop loss, it will then cancel your limit order or your take profit order. That is effectively an OCO, a one cancels other type of order. Let's have a look at a bit more detail with it. Pretty straightforward, really. Let's say we're going to go long at 100. As the market carries on and goes up towards our take profit area of 110, we've got a stop loss at 90. So whichever one gets completed first, the other one order gets cancelled. So as we saw the market rallying, goes on through to our take profit area, our take profit order is filled, and therefore our stop loss order gets cancelled immediately. And that's the whole purpose for an OCO. Let's have a look at the FXCM platform here. Quite straightforward, really. Let's say we wanted to do an order to open. Let's say we want to buy the Dow. It could let's perhaps consider a currency pair, dollar Swiss. Doesn't really matter what it is. We can do 100,000 of it, and then what we're going to do is we're going to look at a particular price a little bit lower than the current market, move down a few pips there. Say it's all a bit random what I'm doing, but we're going to put a stop loss in. Let's put a stop loss in a little bit lower. Let's put our limit in a little bit higher. Doesn't really matter whatever we're doing here, but the point is that is our framework for the trade. Okay, so we're going to place a buy at this particular price. And if that order is completed, then we'll have an OCO in place. That OCO, one cancels other, means that we'll have a stop in place and a target in place, our limit. Whichever one gets hit first will cancel the other. So if we get stopped out on the trade, okay, so be it. We don't want that limit order working anymore to take profit because there's no order to take profit from. So we need to cancel that, and by using an OCO in that way, it will cancel that order automatically. Now, in the old style of platforms, it used to be that that limit order would still work often until we actually cancelled it manually. And of course, as you can imagine, if you don't manage your account particularly well, if those orders are still working, you could end up getting into all sorts of horrible problems. But an OCO prevents that. So just to recap, we go in a trade, an OCO is used with our stop and our limit. Whichever one gets hit first, the OCO then cancels that out for us. As I say, OCO doesn't tend to be a term used so much because it's built into the platform.